Hi everyone, thank you for joining us today. The slide deck can be found in the handout section of your webinar toolbar. Please also use the questions section on the right-hand side to ask questions throughout the presentation. We will be holding and answering questions throughout the presentation. There will be 4 polling questions throughout the presentation as well, and you have to answer at least 3 of the 4 questions in order to be eligible for the CPE credit. Your CPE certificate will be emailed to you in the next few weeks. We'll also be sharing the slides and the presentation recording link following the live presentation. And now over to today's presenters.
Thank you, Allison. Good afternoon, folks. This is Kevin McNulty. I lead Withum's R&D tax credit practice. Thanks for joining us today. We hope you learn a little bit about the R&D tax credit and the value it provides each year. So, a quick background on myself. I've been at Withum for almost 5 years now, after spending the previous 15 years in Big Four. I was with 3 of the Big Four performing R&D tax credit studies. So this is pretty much what I've done for the last 20 years or so. So I've seen it all from Fortune 500 companies to small startups, federal, state level benefits, audits, etc. So happy to provide as much education as I can on the topic. And overall, we just want to give you kind of the general technical knowledge to identify R&D tax credit opportunities over the next hour or so. And then an overview and understanding of the rules themselves and how it may relate to activities taking place at your place of business. I'd also like to introduce my second in command, Tyler Collins.
Thank you. Good afternoon, everyone. I'm Tyler Collins. I'm a manager at Withum's Research and Development Tax Credit Practice. I've been here for about 4 years now, and then my 5 years prior to Withum, Big Four, where I've been doing R&D tax credits since I was an intern.
Okay, thanks, Tyler. And as we go along, folks, please feel free to present any questions in the box on the right-hand side, and we will do our best to address them during the presentation or at the last few minutes. We've kept about 10 minutes or so at the end of the presentation to discuss some of the questions. If not, we'll get back to them after the fact. But please feel free as we move along to present them. So overall, the R&D tax credit, it's been around for about 40 years or so. And in essence, it's a dollar for credit as opposed to a deduction, so a little bit more valuable. And overall, the benefit is it's an incentive to keep jobs here in the United States. It's a permanent tax benefit. It can be, if not utilized in a given tax year, it can also be part of a 20-year carry forward, as well as a 1-year carry back. And oftentimes, many taxpayers avail themselves of the benefit each year on the tax return, as it is looked at each year and it's filed for on its own form, Form 6765. So in essence, it's good to investigate taxpayers to investigate whether or not they do have some R&D activity to see if it could prove to be a benefit in any given year. Okay, Allison, next. Legislation. So in the last few years, some important aspects have cropped up. Permanency of the credit. So up until just a few years back, it was part of the extenders package that Congress dealt with at the end of each session each year. So in beginning after 2015, the R&D credit did become a permanent part of the tax code, which provides kind of a constancy and a deliberateness in terms of looking at each year. So the taxpayers now know that it will be there each year for potential monetizing. So that's a great part of legislation. After, believe it or not, 35 years, it became a permanent part of the tax code. So we're happy about that. It does have support from both sides of the aisle. So as the new presidency and the administration gets settled in, we're hoping for even increased benefits in R&D, but that remains to be seen. In addition, a few years ago, qualified small businesses came into play. Well, we'll talk a little bit further about that in a couple of slides, but basically, because the R&D credit's part of the general business credits, taxpayers required taxable income to use credits. So in essence, they had to be making money in order for them to be allowed to benefit from the R&D tax credit. Otherwise, it would have to be put on the 20-year carry forward. But what happened a few years ago is the tweak to the rules was the fact that these small businesses, if they have not been in existence more than 5 years and have not yet exceeded 5 million in sales, gross receipts, then they can fall into this QSB, qualified small business payroll tax credit, which means they did not need taxable income to offset the R&D tax credit. They could use it against their payroll tax liability each quarter. We'll talk a little bit more about that, but that's very important as well. And then finally, most recently with the PPP loan forgiveness, just recently, the IRS interpreted the rules a few months back that if salaries that were part of the PPP could not be used in the R&D tax credit as qualified research expenditures. But then Congress cleaned that up soon thereafter and said, no, there would be no issue that even if a taxpayer availed themselves of a PPP loan, they could also take an R&D credit for the same expenses. So that brought us back to business as usual after a little bit of uncertainty there a few months back. Okay, Allison, please. All right, Tyler, you can take over for the general rules themselves, please.
You're muted, Tyler.
Tyler, you're muted.
Sorry about that. So the R&D tax credit, it's really an activities-based credit. And you look at all the activities that are performed in a 1-year snapshot in time. So most taxpayers are calendar year taxpayers. So you look at all the activities that were performed from January 1st through December 31st, and you apply them to a series of tests that we call the R&D 4-part test. The 4-part test is intentionally broad, so it can apply to virtually all industries and all taxpayers, regardless of the size of the company. So the first test is the technological in nature test. So this looks at the nature of the activities being performed in that given calendar year. And we need to determine whether those activities were sourced from a hard science. So a hard science would be defined as chemistry, biology, computer science. So the activities being performed had to rely on a principle of a hard science. Test 2, functional development, also known as permitted purpose. This looks at the business component that was being created during that ongoing tax year. And the business component, that's really the thing that you're developing, whether it's a new pharmaceutical drug, a new widget, or a piece of software. So it's that tangible or intangible item that you are building. And test 2 really states that that business component that you're building must be new or an improvement to a previous iteration that you developed. And if it's an improvement, it must be an improvement with regard to performance, functionality, reliability, or quality. So the first 2 tests, they're fairly black and white and static in nature. It's really either yes, you do it, or no, you don't. But we'll see the slide when we go into test 3 and 4. This is where area and where we need to insert our judgment as to maybe what percentage of somebody's time qualifies for the tax credit. So the third test is that technical uncertainty test. So what this means is that either at the outset or during the ongoing development efforts, your engineers or developers had to have encountered technical uncertainties, those challenges and headaches that kept them up at night in trying to develop a product. So you would encounter an uncertainty, and then you would evaluate one or more alternatives to uncover that uncertainty and continue on with the development efforts. And that blends nicely into test 4, process of experimentation. So when you identify one or more alternatives to overcome your uncertainty, you perform an experiment on them to see which yields the better result. And a process of experimentation could really be as simple as iterative trial and error, or as complicated as simulating and modeling. And then from there, we have our first polling question.
Allison, did we want to read them aloud and then just show the results?
Sorry, I messed that one up.
No worries.
So we'll move on and we'll catch that on the next one.
Okay. All right, folks. So what Tyler took us through was the general 4-part test. And the 4-part test are the rules for all industries looking to avail themselves of the R&D credit. So they're somewhat vague in nature, but they have to be applied to all industries here for R&D tax credit purposes. We call that the qualitative piece of kind of the two-pronged approach for R&D. And then once it's established, you know, the activities being performed by taxpayers, we need to put a dollar amount on them. And this is the quantitative piece. So what we have here are these costs are those that can be included as qualified research expenditures, QREs. So what we have here is, we like to call the first and third categories together as people time. So we're going to have wages paid to employees who are performing the qualified activity. So basically how this works is W-2 box 1 amounts are used, and a percentage is applied against those amounts to begin quantifying the QRE at the wage employee level to be included for R&D tax credit purposes. I'll just jump to the third-party contractors there to keep in that people time scenario. And this is also, in essence, this would be 1099ers. So the first wage category would be the W-2s, and the third-party contracts would be your 1099ers who are working on your behalf, performing the same tests, the same rules apply to the third-party contractors. We can include them at the qualified percentage. Keep in mind, for third-party contractors, there is a 35% shrink back. It's just the way the rules are written, and whatever the invoiced amount was for that particular contractor, it would be scaled back 35%. So we call that the people time. Normally that formulates the largest piece of the qualified research expenditures, but for some taxpayers, the supply category, that second category there, could be quite lucrative. Raw materials, prototypes, and things of that nature can be included in the supply category as well. And then finally, and most recently, very relevant, has been the rental or lease cost of computers, most notably cloud services, Amazon Web Services, Microsoft, Google. If these monthly costs, which could be quite significant at times, can be linked back to the qualified activity being performed by the employees and the contractors in the cloud, we can include some of that monthly cost as well to be accumulated in the overall qualified research expenditures. So once the 4-part is established, as Tyler took us through, we put the dollar amount on it based on these categories of costs, and that begins to formulate your R&D tax credit. Later on in the presentation, Tyler will walk us through a specific example as to how the credit is derived from these expenses. Okay, Allison, thank you. Here's a nice snapshot, folks. In essence, this is a nice visual of the R&D tax credit. You know, the field work or the process employed, meaning one of the initial asks are organization charts. We like to understand how an organization is structured in order to begin identifying the qualified folks, those wages, the W-2ers from the previous slide there. So we look, we ask for org charts, and then you begin to focus on, of course, the R&D engineering there, right in the middle. That's usually hardcore, high percentage qualified R&Ders. You could also have potentially one level up overseeing them, senior management. They could be includable as R&D as direct supervision. Then you also have, per this org chart, the quality assurance test lab. That could be directly supporting R&D activities. So you do have to understand a little bit about a company to figure out where the R&D is, as the low-hanging fruit could be the engineering area, but there could be some folks from the other areas in the org chart that could be performing qualified activity. And that time, the time allocation related to that qualified activity can run the gamut. It could be from 0 to 100% of qualified folks. And that would be the percentage we apply against their W-2, box 1, as I previously mentioned. And here are just some categories. The top half of this is more higher percentage, obviously R&D, supervising the R&D, prototyping, testing, support. Those are going to be percentages of qualified activity. Then you get down to the lower half here, general production, general admin. You may want to investigate that from a high level to see if there's any of those activities that may be applicable to the 4-part test. And then finally, once again, here's just another visual presentation of the quantification of the 4 buckets of costs that can be includable to generate an R&D tax credit. Funded research. This is an interesting aspect, folks. We wanted to put one slide in here because oftentimes it can be a large piece of the R&D investigation for a taxpayer. What this is all about is understanding really 2 aspects of a relationship between a taxpayer and a third party client or customer. Basically, what this pertains to is understanding who is doing work on behalf of someone else. And if there's IP, intellectual property involved, we need to understand that as well. And basically what it comes down to is who bears the financial risk of the development. So if a taxpayer is doing work on behalf of a customer, and the customer asked them to do something, contracted with them to do something, and it's based on them producing a product, an end product, the financial risk will be bared, excuse me, by the taxpayer, because if the end product is not reached or achieved, the time spent on that would still be at risk for the taxpayer, obviously, because the employees doing the work would still have to be paid. So they would bear the financial risk. If it's based, if the contract reads that no, we'll pay the taxpayer for their time, then there may not be a financial risk because they're being paid anyway for some of the development effort. So in funded research, basically funded is negative in terms of the taxpayer who's claiming the R&D tax credit, because we've got to make sure that they do bear the financial risk and hold some rights, substantial rights to the outcome of the research. In other words, if the contract reads that the customer is entitled to all intellectual property and the taxpayer is not allowed to exploit it, then once again, that would be funded for the taxpayer because they don't have substantial rights. So this comes up quite a bit in contracted situations and relationships, and that's why contract review could be quite important, because we have to look into these 2 main aspects to understand if it's funded or not. So we just wanted to kind of put that out there. Okay, Allison. All right, and Tyler will take us through qualified small business.
All right, so Kevin gave a nice introductory to this a few slides ago. I'm just going to go in a little bit more detail as to what constitutes a qualified small business. So generally speaking, startups within their first 5 years are generally your qualified small businesses. But you do need to pass a series of 2 tests in order to get that QSB designation. And both tests really revolve around gross receipts. So there's the 5-year rule and the actual amount of gross receipts you generated in the calendar or tax year in question. So the 5-year rule really states that you cannot have generated any gross receipts prior to the 5th previous tax year, including the current tax year in question. So what that means is for a 2020 R&D tax credit claim, you cannot have had any gross receipts prior to 2016, not even $1 of bank interest, as there's no de minimis rule that the IRS instituted. The next test is the $5 million gross receipt test. So for 2020, you cannot have generated any more than $5 million in gross receipts. And again, gross receipts are defined as sales plus investment income. That's your interest, dividends, royalties, etc. And the lower half of this slide really just states the maximum amount that you can take as a payroll tax credit. It's either really the lesser of the actual tax credit generated or $250,000. So there is that $250,000 cap every year that we need to keep in mind. But if you generate any credits above and beyond that $250,000 mark, you don't lose it. It just becomes a tax credit that you can only use against federal income taxes. And if you're not yet taxable, it just goes on a 20-year carry forward schedule. So the payroll tax offset, what exactly is it offsetting? It's serving to offset the employer portion of payroll taxes. So if you're a taxpayer and you have employees on your books, you're paying a 6.2% Social Security tax on your employees every quarter. So what this credit serves to offset are those taxes that you pay quarterly. Again, the maximum benefit is $250,000. And to the extent that in a given quarter you have more credits than you do payroll taxes, the credits simply carry forward to the next quarter and will continue to do so indefinitely until they're completely extinguished. And then to the extent that you are paying federal income taxes, as well as you have employees on your books and you'd like to use the R&D tax credit for both purposes, you can absolutely bifurcate the credits, and you would do so on Form 6765, which is the form we use to monetize the R&D tax credit. Polling question 2.
Yeah, and Allison, I was getting a question that folks were having some issues, so let's give them plenty of time to deal with polling question number 2, please.
Yes, do you want to read the question out loud?
Certainly. Polling question number 2, what types of qualifying expenses can be claimed for the R&D tax credit? Wages, contract research expenses, computer lease or rental expenses, or all of the above? Okay, Alice, we can give them a few more seconds and then we can log the answers.
Yep.
Are we able to show the results?
Absolutely.
All right, so we're paying attention. All of the above is absolutely correct. Those would be the categories that we can include for R&D purposes. Okay, so I briefly mentioned about, the R&D tax credit is available to all industries out there. So what we have here is a listing of those industries, businesses that normally avail themselves of the R&D tax credit. It does run the gamut from the obvious in terms of pharmaceuticals and aerospace, et cetera, to maybe the not so obvious in terms of banking, retail, manufacturing, et cetera. I do want to point out that you'll notice that while this is a non-inclusive list of taxpayers that can benefit from the R&D credit, you'll notice that software R&D is going to be relevant to many of them, meaning, for example, banking and insurance is not necessarily in the software business, but their R&D credits will revolve around software development because of how the R&D credit, you remember the first test, it's a technical driven credit. So while banking and insurance are in the industry, the business of making money, the underlying R&D would be software. So it does kind of run the gamut, and that's why software is a large chunk of the R&D activities in any given year across the country. So, just focusing a little bit on software, especially in the last decade or so, how everything has pretty much moved to some type of software development, whether you're a mom and pop shop now, all these startups, the vast majority of them are going to have some software type activity taking place, whether it be application development, right? Because everyone has the apps now, there's apps for everything out there. So that's huge business. And then you have some more mature type of businesses, TurboTax, right? It's tax season, so a lot of folks are using that. StubHub for tickets. It's all going to be based on software, video game development. That's kind of obvious. And then you get into nuances too when you look at clients. When we're thinking about how much of their activity could be qualified activity, you also look at things like hardware, software interaction, things like that. The starting point of software, algorithms. The mathematics behind it before it gets into the software and so forth. Encryption security has been a big thing now, especially with all, it's pretty much seeing a story a couple times a week in the paper about how companies have been hacked and our data has been sold on the dark web. So security and encryption is a big piece of it now because there's a significant amount of spend for companies on protecting their data and their clients' data as well. Okay, Allison, next slide, please. And, this is more as an FYI, this slide. We wanted to stress how it truly is very expansive, the R&D tax credit. So, while we focused on software in the prior slide, this is the activities. The R&D, it's an activity-driven credit. So it's also understanding what it is a taxpayer does. You'll notice, like from the first bullet there, trial and error, experimental. That's the fourth test, that process of experimentation that Tyler took us through a few slides before. Some of the buzzwords or activities we look for, patents, things like that. If a company has filed for a patent or is thinking of filing for a patent, that speaks to the uniqueness or novelness of a taxpayer's development, and that more often than not would fall into the R&D type of inclusion. New novel technologies, prototypes, pilot models, things like that are the underlying aspects that a taxpayer may do that may not be so obvious in terms of qualified activity. So we put this here as an FYI, just to kind of like show that there are many things you need to understand as a taxpayer to understand how large an R&D tax credit they could have. And then at the bottom half there is, not everything qualifies, right? It's all about from the federal R&D tax credit. We focus on U.S. soil development. It's one of our first questions we ask was this work done in the United States? Especially now when a lot of development, especially software, is being offshored, we can bifurcate, but we need to focus on claiming just those aspects that were done here in the United States. Some other things that are high risk type of qualified activities, reverse engineering, believe it or not. The government's thinking there is that the R&D was already claimed when it was engineered, so they're not going to give credits again for reversing it. Routine data collection, efficiency studies, research related to style, taste, cosmetic, etc. Those things, which sometimes can be gray areas, need to be investigated to make sure that those type of activities and related expenses are minimized in any R&D claim. Okay, Allison. And just expanding a little bit further and understanding taxpayers, what are some of the basic things you can look for? 10K, obviously, for those clients, taxpayers of a certain size. Check for R&D spend, acquisitions, dispositions. In other words, from a strategic perspective, we ask our clients each year when we investigate their R&D, hey, have you acquired someone? You may have acquired a small R&D shop when you weren't traditionally an R&D'er, but you brought on maybe a 5 or 6 man shop that does do R&D. So we want to understand how the company looks in a given year. The income taxes, tax returns, things like that. And of course, because it's a technical driven credit, one of the first things we ask for, how many techies do you have on staff? Engineering, software, chemists, and the like. So that pretty much tells us if you have more than a few, it's more likely than not that there's some R&D taking place and it should be investigated. And then from a little bit of deeper dive in the tax returns themselves, Form 6765 is the R&D tax credit itself. The R&D credit can be carried forward for 20 years. So sometimes clients have put the R&D investigation on the back burner and we see carry forwards from a few years back. So that can kind of help us refocus for a taxpayer whether or not they have some R&D. And then some other things we look for as well. Okay, Allison. And here's polling question number 3. Which of the following is considered a non-qualified R&D activity? Activity involving experimental-like? I'm sorry, I just can't see it, the full question. Research conducted in Ireland, and activity resulting in the filing and/or securing of that should be a patent, not a patient. Activity involving third-party design engineering services. We'll give you a few seconds for that. All right, a couple more seconds, then we can close it, Allison. Okay. And yes, the vast majority correctly selected research conducted in Ireland. Now, keep in mind, as we're talking, this is the U.S. federal R&D tax credit, so the first, third, and fourth are absolutely qualified type activities, but for U.S.-based tax credit, the research conducted in Ireland would not be included. Okay, and I think we're going to move on now to a case study that Tyler's going to walk us through, which is nice because this will bring us all together, the rules in terms of the qualitative, the 4-part test, and the quantitative, the associated costs, and how it all comes together for a taxpayer in this case study.
That's exactly right, Kevin. So this does put it all together. So in this case study, a financial services firm wanted an R&D study performed. And just going through some of the bullets below, they're a C Corp founded in 2017, so they're within that 5-year mark. They have a total company headcount of 10 individuals. It was determined that 5 of them were performing R&D type of activities. The other 5 may have been more general admin in nature, or maybe a business analyst, someone who's not really doing R&D. The 5 who are doing R&D are creating a new platform for their firm from the ground up, never done before. And in going through every part of the 4-part test, it checks every box. And then once the development efforts are done, then it is released to their customer base. So this is a really good visual representation, a very high level, of an R&D tax credit study and the field work we employ. So you'll see in the top half, that's really dedicated to employees. So we do go employee by employee and determine what percentage of their time is deemed eligible for the R&D tax credit. Again, applying their activities to the R&D 4-part test. You always go back to that R&D 4-part test in order to determine your qualified versus non-qualified time. And you'll see that they qualify at varying percentages based upon what they were doing in that given calendar year. So you have your CTO, which is a Chief Technology Officer. So they're getting their hands dirty, doing R&D and supervising R&D. So they qualify at 100%. If you go down a bit, we have an analyst. So in this case, they spent half their time on non-R&D type of things, and then the other half helping with the coding and development of their platform. And then I'll also point out a very nuanced area of the R&D tax credit. Jane Doe, data scientist. She qualifies at 80%, but you'll see in the column over, it defaults to 100. And that's because the IRS implemented a sub-all rule. So once it is determined that 80% of someone's time qualifies for the credit, we can include 100% of their Box 1 W-2 wage amount for the R&D tax credit. So we go employee by employee, multiplying their R&D qualified percentage by their Box 1 W-2 wage amount, and the product of the two yields a qualified research expenditure. So you just add all of the QREs, qualified research expenditures for all the employees, and then you get about $625,000 of wage QRE. Then you perform the same analysis for the contractors. And as Kevin mentioned before, there is that 35% shrink back. So you'll see that even though they're qualifying at 100% for the credit, they are capped out at 65% of their invoiced spend. So you multiply that 65% by their invoiced spend amount for that year. And again, you yield a contractor QRE. And then additionally, we have some cloud computing. They were using Amazon Web Services to test and develop their code. So we get to claim those expenditures as well. So when you add up all of the buckets of expenditures here that qualify for the credit, we get approximately $956,000 in aggregated QRE. And it's those QRE amounts which get fed into the R&D tax credit calculations. And as you'll see on the next slide, we go through the regular credit here, and there's also another R&D tax credit calculation called the ASC. We'll do the regular first, but you'll see that they are different, and then the IRS allows you to choose the credit calculation that yields the greater result. So with the regular R&D tax credit calculation, you'll see all of those QRE buckets up top. You got the wages, your cloud computing and contractors aggregating at $956,000. And I'm not going to go into too much detail, but you need to overcome a base. So it's the delta between your base and your current year expenditures, which yields a credit. For the regular credit, your base is formed through your average annual gross receipts and a fixed base percentage. Once those are established, you just run those QREs through a series of factors, and it spits out an R&D tax credit of $95,600. And then here's an example of the ASC credit calculation, the alternate simplified method. So you'll see again those buckets of qualifying expenditures up top, yielding $956,000 of QRE. And rather than the regular credit, which uses a factor of your average annual gross receipts and a fixed base percentage, what the ASC does to form its base is it takes the average of the 3 prior years of qualified research expenditures. So in this particular instance, it's really a 4-year R&D tax credit study, because you need to not only look at the current year in question, but the 3 prior years as well. And you'll see that the ASC actually yields a greater credit than regular. approximately $100,000. So that's what we would use for this particular taxpayer and what we would file on their Form 6765. So this is page 1 of Form 6765, and this gets filed with your federal tax return. So it's the filing deadline of your tax return, which establishes the deadline that you need to get your R&D tax credit finished by. So you'll see on page 1, we filled out section B, and section B is for the alternative simplified credit. So because that yielded the greater result, we fill out that particular section on Form 6765. And this is the second page. We just continue to carry that credit through the lines. And then section D is important because this is where you distinguish that you're going to be using this tax credit to offset payroll taxes. So you'll see on line 41, that's the check in the box that we need to make sure is performed to let the IRS know that we're using this tax credit for the payroll tax purposes rather than federal income taxes. So the quarter after you file your federal tax return with the Form 6765, the quarter after, the credit becomes live, so to speak. And how it becomes live is through this bridge form, Form 8974. So everything in this form is really just a derivation of Form 6765. And the purpose of this form is for a taxpayer to provide it to their payroll provider or a professional employment organization, such as TriNet or JustWorks, whoever's filing their quarterly tax returns. So if we were to have filed the federal tax return in Q2 of 2020, the credit becomes live at the end of Q3. Next slide. So depending upon whether you prepay your Social Security taxes or you pay in real time, you will either see an offset to the employer portion of payroll taxes, or you'll receive a check from the government in the amount of the payroll tax credit, which was offset by the credit. And again, to the extent that credits exceed the payroll taxes, they do carry forward indefinitely until exhausted. Polling question number 4. What is or are the acceptable calculation methods for quantifying the R&D tax credit? The alternate simplified credit, the regular research credit, both A and B, or neither A or B?
And as we're giving folks time to answer this, Allison, we will rerun question number 1 in a few minutes, just so people could have a chance to redo that, as it appears there was some technical difficulties.
Yes, we'll redo it towards the end.
Very good. Thank you. All right, a few more seconds, then we can close the poll. Okay, Allison, I think that's enough time. Yes, so the accepted calculation methodologies do include both the ASC, the simplified method, and the regular research credit, both A and B. And as practitioners, what we often do is we do ask for the respective data sets in order to calculate both of them. The simplified credit was brought in several years back because the regular research credit really did not move on in terms of a rolling average. Believe it or not, the base period for that still resides in the 1980s, when the credit began in the early 1980s. So the base period never became a rolling average. So they did the right thing many years ago and implemented the simplified credit, where the base period just became a rolling average of the prior 3 years. The whole concept there is the fact that the government gives R&D tax credit consideration to increase R&D spend. So there has to be a formula in order to create that base period upon which the first dollar above that begins to generate the credit. But basically, you could look at both methodologies, but the majority of taxpayers now are using the ASC, the simplified credit method. Okay, we'll do a few more slides, then we'll rerun polling question number 1. Okay, so some documentation now. The R&D tax credit, while we went through, oftentimes you talk about the most important first step, which is the calculation itself, because that gets on the tax return, that gets filed for, and that pretty much triggers the monetization of the R&D tax credit. But just as important is the documentation, the support of R&D claims. While the support is not required for filing tax returns each year, it is absolutely required to support your R&D claim. Basically, the IRS does not require taxpayers to support and document all of their R&D claims each year, but it has to be a minimum level of documentation. And it is a case-by-case basis, taxpayer-by-taxpayer basis. But here are some of the things we look for, and we also recommend that taxpayers may keep on hand year over year to support their R&D claims, whether it be annual R&D plans, tech plans, management reporting, simple management reporting, whether it be monthly, quarterly, often have some very strong aspects detailing the R&D type activities, the 4-part test themselves. So they can be quite helpful, as are PowerPoint presentations, issue logs, things like that. Oftentimes we include email correspondence from maybe, excuse me, an engineering lead or a department head going back and forth with his team to discuss the technical challenges. That pretty much is the support oftentimes for R&D claims as well. So most of it does not have to be created. Most of the documentation is probably available in an everyday goings on it at taxpayers. So that's why this becomes an important kind of piece of the puzzle here, because it lessens any additional kind of responsibilities on taxpayers when a lot of it could already be created for other reasons, but can be used in support of R&D tax credits. Next slide, please. So bringing it all together, folks. So in essence, what we presented today was a high-level understanding of the R&D tax credit. It's been around for 40 years and will continue to be around for taxpayers to avail themselves. There are a couple of ways to calculate it, the regular and the simplified credit methodology. It's based on the 4-part test. And then once you've established the activities being done, you put the dollar amount on it by putting those 4 categories or so of qualified research expenditures. And then you can monetize it either the traditional route against taxable income, or if you're a small startup, not in existence for more than 5 years, nor have you exceeded that 5 million mark in sales, you can go the payroll tax offset. So basically what we do here at Witham is we can help you with a complimentary assessment. Basically, this would be a 30-minute introductory call with some folks at the company to understand what has taken place in a given year or years, as you are allowed to go back up to 3 years for R&D tax credits, believe it or not. If you want to amend tax returns, you can do that in order to kind of catch up on your R&D tax credits. We do that often for taxpayers. So this complimentary kind of phone call is understanding what's taken place to see if there is some activity that should be gone after in order to potentially benefit from the R&D tax credit. We understand what's going on at the company, and then the result of that would be a high-level estimate of what the R&D tax credit could be, so that the folks can make an informed decision as to whether or not they should move forward with a more formalized R&D tax credit study. And here's a nice, snapshot of the full process itself. The complimentary assessment, which I pretty much just explained in the prior slide, pretty much triggers or begins the overall process. So some taxpayers may see it's not worth it to go after in a given year, and then we talk to them again the next year if R&D spend has gone up and so forth. For those that do like to move along, then we truly get into a full, robust R&D tax credit study, which is really that two-pronged I spoke about, the quantitative and qualitative analysis, pretty much understanding those activities, the four-part test, and then putting the dollar figure on that. And then from that, we accumulate the data, we put it in overall deliverable filing for the tax return purposes, and then of course a full deliverable with all the qualitative support, et cetera, for the taxpayer in order to, should taxing authorities ever come knocking on their door asking for support of the R&D credit, they will have an IRS-ready deliverable. And then finally, in the small chance that an audit does take place, we are of course here to defend any R&D studies we do. But audits, while the IRS is, they do look at R&D tax credit studies from a general percentage perspective. Audits are fairly uncommon, but nonetheless, support should be gathered each year for your R&D tax credit claims. And then we just want to thank you once again, folks, for taking the time to chat. We will go through the polling question number 1. So we can play catch up here so we get our CPE credits. What test is used to determine if an activity qualifies for the R&D tax credit? 2-part, 3-part, 4-part, or 5-part test? And this would be the general rules we explained earlier. All right, a few more seconds, Allison, and I think we could close it up. So yes, the rules themselves is based on the 4-part test that was shown earlier in the slide deck. And once again, all taxpayers that are looking to avail themselves of an R&D tax credit need to meet all 4 of those tests. So thank you for that as well. We do appreciate your time. There's Tyler and my contact information. Please feel free to reach out if you have any additional questions. I think we answered a couple of questions. And once again, apologies for the technical challenges. Hopefully everyone is now caught up on their CPE requirements in terms of answering the questions. But we do hope you enjoyed today's presentation of the R&D tax credit. Thank you for your time.